Hi, my name is Steve Parr. I'm a business lawyer in Vancouver, Canada. And are you confused about which business structure is best for you? If you are, this video is for you. This is going to cover off which will provide you with the most tax savings, which has a more hassle-free setup, and which one has the least personal liability. So, time to stop scrolling, watch this short video, and finally get clarity on which business structure is right for you. Today, I'm going to answer your questions about the most common ways to structure a business. This short video will give you the details on the legal and tax aspects of each, helping you to decide which is right for you. So let's jump right into it. Question 1. What are the best business structures and how are they created? A sole proprietorship is an unincorporated business owned by an individual and can be operated under a registered business name or the individual's personal name. There is no process to create a sole proprietorship since it is unincorporated. However, if you do want to register a business name, that is going to be done through the province where the business is carried out. So in British Columbia, that's going to be done through the BC Business Registry. Partnership is an association between two or more individuals that join together to carry on a business with a goal of making a profit. There are 3 criteria that must be met to indicate the existence of a partnership. The criteria is going to be 1, that their business exists itself, 2, that is carried on in common by the partners, 2 or more individuals, and 3, that they have a goal to make a profit. Third entity is a corporation. This is the most common structure. So a corporation is a legally established entity that can own assets and incur its own debts. Its own individual. Basically, it's a type of person. So a corporation is owned by shareholders. This could be 1 shareholder or it could be 100. And in many cases, if you are the business owner, you may be the sole shareholder. So the steps to incorporate are as follows. You're going to identify what name you want for the corporation, and then you're going to determine what kind of content you want for the articles of incorporation, including the special rights and restrictions and the share structure. You're going to create that agreement, and then you're going to make an application to incorporate. All of this is best handled by a competent corporate lawyer in the jurisdiction that you're working within. A professional corporation is a legally established entity that is going to be regulated by a governing professional body such as the Law Society of British Columbia or the College of Physicians and Surgeons of British Columbia. And it's usually going to be subject to the investigative and regulatory powers of that governing professional body. These are typically formed by dentists, doctors, accountants, lawyers, engineers, and the process is the same as incorporating, but there is going to be specific language inside of the articles, the special rights and restrictions that are specific to that type of profession and the governing legislation regulating that profession, such as the Health Professions Act. Question number 3, how are you going to finance this business entity once you have set on a particular type of entity that you're going to work with? So a sole proprietorship is generally going to be financed through your own personal capital or funds that you've borrowed personally. The same goes for a partnership, but of course your partner or partners may have their own sources of capital. And there are generally going to be more sources of investment capital because there are more parties involved. So with a corporation or a professional corporation, the shareholders can invest their own capital, or as a separate legal entity, they can borrow the funds in the name of the corporate entity, i.e. you can set up a dental corporation and then that dental corporation can go to the bank and get a loan. Or shares or other forms of equity such as options could be issued to investors to earn more capital. Questions 4 and 5. What is the legal status and who has the legal liability in these different structures? So with a sole proprietorship, as I mentioned earlier, there's no distinction between the owner and the business itself. That means that the owner has unlimited personal liability for the debts of the business. So be careful. A partnership similarly is also not a separate legal entity from the individual. General partners are going to share unlimited liability for the debts of the partnership, similar to a sole proprietorship. So you want to be even more careful about who you're going into business with. Liability is jointly shared and does extend to the personal assets of each partner, including houses, cars, etc. With limited partners, liability is going to be limited to the amount invested. So if you want to go the limited liability partnership route, you can do so. Make sure that you consult with a lawyer and get an LLP agreement properly structured. There are additional steps that need to be done with the registrar as well. Okay, now turning to a corporation. A corporation possesses the same rights, obligations, and liabilities as a person, and liability stays with the corporation and is generally not extended to the personal assets of the shareholders. This is also referred to as the corporate veil. However, directors or officers may be personally liable if the actions of the corporation are fraudulent or grossly negligent, or most commonly, if they don't pay their GST, their PST, or if they don't pay wages to an employee, the director is going to be held personally liable for those amounts. For a professional corporation, it is also a separate legal entity and is going to need to be certified by the relevant professional governing body. The shareholders, again, do enjoy some limited liability protection, but the professional is going to be jointly and severally liable with the professional corporation for any professional liability claims made against the professional corporation. So there's not a whole lot of protection there. Your protection is going to be derived primarily from insurance that you have as a professional. Who controls the business? So if you are an owner of a sole proprietorship, you have direct personal control. It's your life, it's your business. For partnerships, the partners share control, and a partnership agreement can be established to define control and clarify who is responsible for what in terms of managing the entity. In a corporation, the shareholders with voting rights elect the directors that control the business. The directors themselves are the ones who control the business. So, of course, if you incorporated your own business and you're the only person involved, then naturally the control falls to you. So if you're the sole shareholder of a professional corporation, you have direct personal control. Otherwise, control is shared with other professional shareholders, and similar to a partnership, an agreement can be written and signed to define control and management, also referred to as a shareholders agreement. Moving on, what is the tax year-end date and how are you going to be taxed? A sole proprietorship, just think of it as a personal tax return, so a T1. A sole proprietorship's tax year-end is generally going to be December 31st, and income is going to be taxed personally. All income that you earn, all expenses that are incurred during the course of trying to earn that income can be deducted on your personal tax return. Talk with your accountant for the finer details about that. Usually partnerships with at least one member who is an individual or a professional corporation, for taxation, each partner's share of the profit is going to be taxed personally in their hands. Now, subject to a few restrictions, corporations can generally choose any tax year-end that they wish, with income first being taxed within the corporation. Then, after-tax income may be distributed to shareholders and taxed in their hands at their appropriate time. For a professional corporation, they can generally choose any tax year-end that they want. What are the potential tax advantages of these different structures? For a sole proprietorship, if there's a realized loss, i.e. a loss that is incurred during the course of running the business, that business loss can be written off against other personal income. This can be hugely advantageous during the early stages of a new business venture. You can also personally deduct certain expenses that you incur to earn the business income. If a partnership has realized losses, those losses similarly can be allocated to each partner and can be generally written off against the partner's other personal income. Corporations and professional corporations have many tax advantages, which include tax deferral, the lowered small business tax rate, which I've covered extensively in other videos, and may also have income splitting opportunities if you have other individuals that are within your family who are working inside of the business. There's also the ability to claim the lifetime capital gains exemption, which I also cover in other videos. There's flexibility in how you remunerate yourself in terms of whether you could pay yourself via a dividend or via a salary. You can provide employee benefits. You can have your corporation cover off medical expenses through the use of an HSA or a health spendings account in order to use corporate dollars to pay for medical expenses, and so on. There are a variety of different advantages that can be realized by using a corporation for your business, but whether it's appropriate for you or not is really going to be determined on a case-by-case basis, so feel free to hit us up. We're happy to chat with you about that. It would not be uncommon for a corporation owner to be able to save hundreds of thousands of dollars in taxes through the lifetime of their business. So what are the potential tax disadvantages? So with a sole proprietorship and a partnership, again, the income is going to be taxed at your marginal tax bracket, usually in the year that it is earned. There's no opportunity for tax deferral, and you might be stuck in the highest marginal tax bracket, which, if you live in BC, is 53.5%. For corporations and professional corporations, the tax disadvantages may include a restricted use of business losses, i.e. business losses that you incur inside of the corporation are not going to be able to be applied to your personal T1 income. There's additional tax complications upon the death of a shareholder and potential employer health tax obligations as well. To conclude, there are nuances to each business structure, and the best one for you will of course depend on your personal situation. If you're looking for assistance in this area with business ownership, incorporation, taxes, wealth planning, please reach out to us here at Par Business Law. We are happy to help you. Thanks for watching.